Welcome to our guide on mutual funds, which is also one of the, if not the most popular investment instruments in the world. Whether you are just starting out on your financial journey or you are a seasoned investor seeking to optimize your portfolio, mutual funds have become the go-to instrument. Picture this: access to a diversified portfolio managed by financial experts, the ability to invest with minimal capital, and the opportunity to ride the waves of the market without the stress of individual stock selection. In this video, we will unravel the concept of mutual fund investing, explore their benefits for both beginners and seasoned investors, and unveil how they can serve as your ultimate wealth building tool. To begin with, what exactly is a mutual fund? A mutual fund is like a big pool of money collected from lots of people who want to invest. A team of experts then takes that money and invests it in different things like stocks, bonds, or other assets to try to make it grow. Each person who puts money into the mutual fund owns a small piece of everything the fund invests in. So instead of investing in individual stocks or bonds yourself, you can invest in a mutual fund and let the professionals handle it for you. You can invest this amount in a lump sum, which means investing all the money at once, or you can start a systematic investment plan, that is SIP, where a fixed amount will be deducted from your bank account each month. But now the question is, how much money do you need to start investing in mutual funds? Well, not much. You can start a SIP in mutual funds for as low as 50 rupees. With this method, you can set up a daily, weekly, or monthly SIP, which will automatically deduct money from your account and invest it in mutual funds. But mutual funds also have two plans that can be either regular or direct. In regular mutual funds, you have to pay a distribution commission, which in turn raises the expense ratio. But in the case of direct mutual fund, you buy funds directly from the AMC, so no commissions is levied on your funds. In simple words, your returns in direct mutual funds are higher compared to regular because in this case, your expense ratio is lower. Now to see whether you have invested in a direct or regular fund, head to the INDmoney app. Here you can analyze the expense ratio of your funds. Moreover, if you have invested in a regular mutual fund, you can easily switch it to a direct plan for free from the platform itself. Now that we understand what mutual funds are and which category of mutual fund is suitable, let's understand the different types of mutual funds. The first category is equity mutual funds. As the name suggests, when you are investing in equity mutual funds, you are investing in stocks of different companies. The performance of this fund depends on the performance of its stocks. Equity mutual funds are divided into several categories like large cap, mid cap, flexi cap, multi cap, etc. Second, debt mutual funds. Unlike equity mutual funds, in debt mutual funds, we invest in securities that generate a fixed income such as treasury bills, commercial papers, corporate bonds, government securities, etc. All these investments have a pre-decided maturity date and coupon rate. Coupon rate is the annual income an investor can expect to receive while holding a particular bond. This means this is a low-risk investment and is great for risk-averse investors. Third comes hybrid mutual funds. This type of mutual fund is a combination of equity and debt mutual funds. If an investor is neither purely high risk nor low risk, then hybrid funds are a great investment plan for them. This category of mutual funds helps money manager to tactically allocate assets within debt and equity. Fourth, index mutual funds. In this method, we invest in funds that replicate a market such as Nifty 50 or Sensex. Suppose an index fund is tracking Nifty 50, then the fund will have 50 stocks in its portfolio in similar proportion as Nifty. Now to begin investing, there are a few things that you should definitely keep in mind before you start an SIP in mutual funds. The first tip is to set SMART goals. SMART stands for specific, measurable, achievable, relevant, and time-bound. Let's assume that you are saving for your retirement. Now, you need to make a clear goal plan about how much money and in which funds you need to invest and how long will it take you to reach this amount. So for this, you can also use INDmoney's SIP calculator. Let's assume you plan to do an SIP for 10,000 rupees every month for 15 years. The rate at which you expect your investments to grow is 12% per annum. At the end of 15 years, you will have around 49,95,000 rupees. That is the power of compounding and consistency in investing. Second is to diversify your portfolio. Invest your money in different types of funds. This reduces your risk. If you put all your eggs in one basket, and if that basket falls, all the eggs will break. But if you put eggs in different baskets, the fall of one basket won't matter much. So portfolio diversification protects you from risk. Third, invest regularly for long term. That is, patience is necessary. But why? Because if you regularly put money in a mutual fund, it will grow over time and you will also benefit from compounding. Fourth, choose your funds according to your risk profile. It is crucial to understand your risk appetite. You should know how much risk you want to take. Fifth, and extremely important, is tax. In equity funds, if you withdraw money within 1 year, you will have to pay 15% short-term capital gain tax. However, if your profit is less than 1 lakh within 1 year, it is tax-free. If it is more, then you have to pay 10% long-term capital gain tax. In debt funds, if units are sold before 3 years of purchase, then the gains will be termed as STCG and will be taxed at slab rates. However, if they were sold after 3 years, they will be termed as LTCG and taxed at 20% with indexation benefit. Now, what is the indexation benefit in this? Indexation is a method to adjust the purchase cost of an investment by accounting for inflation. This adjustment helps reduce the taxable amount of capital gains when you sell the investment. And one more thing, the expense ratio fees. This is the annual fee for money management, which can range from 1% to 2.25%. This can reduce your returns drastically, so please do not ignore this. Now, if you're wondering how to set up an SIP in mutual fund using INDmoney, then you are at the right place. To get started, register on the INDmoney app and complete your KYC process. This will only take a few minutes and is completely paperless. Once you are in the app, you can browse through a variety of mutual funds. When you have chosen your preferred fund, you can set up a daily, weekly, monthly or quarterly SIP plan through automatic payment via bank mandate or UPI. And worry not, you can edit, pause or cancel this anytime you want. And that's it. There you go. You're all set to do an SIP in mutual funds. To take you one step further, once your SIP is set on INDmoney, you will also get a free mutual fund portfolio scan, in which you will be provided with personalized insights regarding your portfolio. Oh, and one more thing, with this mutual fund tracker, you can also add nominees. Basically, you can opt for nominating persons to receive your investment money in your place, that too for free. Isn't that interesting? Now to conclude, if you begin your investment journey by starting an SIP in mutual funds via INDmoney, then it will provide you an easy, fast, safe and free way of investing in direct plan mutual funds at zero commission. Plus, you will have access to the SIP Center to control all your SIPs at one place. Not only that, but you can also track and import your external mutual funds on the app itself. And along with free analytics, you can also manage funds across all your family members. So go ahead and set up your first SIP. If you still have any doubts, leave a comment and we will be happy to answer them for you. And don't forget to subscribe to the INDmoney's YouTube channel because we are here to decode more such financial topics just for you.